This is The Bottom Line, a show designed to help Australian businesses succeed. On the show, you'll hear from leading Australian business owners as they share the lessons they've learned building their companies. You'll learn from their successes as well as some of the challenges they've faced along the way. We also talk to experts from a range of fields who share specialised techniques you can use to improve your business. I'm your host, Savan Tuna, and I'm a director at Alexander Spencer, and I'm really passionate about helping Australian businesses succeed. Today on the show, we are speaking to Malcolm Ebb, the founder and managing director of FeeSynergy. FeeSynergy is Australasia's leading provider of automated debtor management software and finance solutions to the accounting and legal sectors. In today's episode, you'll hear about how to implement best practice debtor management processes in your business. From credit checks to tax invoices, trade terms and payment methods, you'll learn about the mistakes business owners make when it comes to debtor management. Let's jump in. Malcolm, thank you for joining us today.
Pleasure, Savan.
So today we want to obviously talk about collections, debtor management, and obviously how that impacts businesses in today's environment. But before we do that, Malcolm, you have an extensive professional background. I've known you for a long time. Do you want to tell us about your professional journey?
Sure, I'll give you a short version, Savan. Look, I've been around the accounting and legal scene for a long time, but started life actually in Sydney. So I've been in beautiful Melbourne since 1995. That'd be the year that the Carlton won, I think, the grand final. But my first 20 years of my life was spent in the insurance industry, the general insurance industry actually. And when I came to Melbourne in 1995, I moved into the finance industry, working for a company that was acquired by GE Capital. And that's where I actually met my business partner, Mickey Simonovsky, who you know, Savan. I actually recruited him into GE, which was really nice. But at that time, we were involved in the insurance premium funding industry, which a lot of businesses use that sort of facility through their insurance brokers. But we developed a new product at that stage for the funding of accounting and legal fees. And in fact, your company, of course, uses our services for that effect. But so that was about 2000, I think. And then I left to join a software company. I was asked to come and run a software company in the payroll and human resource space. I knew nothing about software, but the board said, perfect, you know how to run a business. So I did that for a few years. At that stage, Mickey was still at GE, and GE decided they would withdraw from the market the professional fee finance product that we had. I spent 6 months of my life developing that. I was very passionate about it. At that stage, it was about 2005. Mickey and I got together and said, why don't we start up our own finance company to specialise in that type of finance? I mean, after all, Savan, how hard can it be to set up a finance company?
No, not hard at all.
Yes, so naivety, but we had a great concept. We were passionate about it. So we shook hands, said, yep, let's go and start a business to do that. Then the fun started. So the fun being, well, you've got a finance company, you need to have access to a lot of money. So we did the rounds for all the banks, I think for 18 months, 2 years. They all said politely, love the idea, but come back to us in 3 years when the business is operating and successful. After a couple of years of I guess, wearing out shoe leather down Collins Street, we pooled our resources and managed to get our finance business out of the ground. And so it was 2007. I left my job at the software company at that stage to set up the company. So that was a big move. And here we are, 14 years later? Still going strong. But the finance company was the first part that we set up, and then we moved, I guess the word these days is pivot. It seems to be a pandemic term, pivot. But in about 2000 and would be 15, 16, we decided to move into the software industry, so to support our finance offerings, but more importantly to support our accounting and legal firm clients with debtor management solutions. Because at that stage we'd looked at and couldn't find any debtor management platforms that would actually be suitable for accounting and legal firms. So we decided to build our own. Again, how hard could it be, Savan, to start up a software company?
No, not hard at all. I haven't done one myself, but I'm sure it wasn't too difficult, Malcolm.
Yeah, no, it's a piece of cake, Savan. But no, look, we did have a background in software, so it gave us the confidence to, I guess, embark on that journey. And when you had to hire good programmers and analysts and all the sort of things that you need in a software company. And it's great being interviewed by you, Savan, today, because you know that your firm was the first to use the beta version of our data management platform called FeeSynergy Collect. And of course, that platform is used by hundreds of accounting and legal firms across Australia and New Zealand today. And many of your clients, who I presume will be listening to this podcast, would have seen the FeeSynergy name around your practice for probably 5 or 6 years, I suspect now, Savan.
Yeah, no, definitely. We're really excited to be the beta test for the FeeSynergy Collect platform. Definitely changed our collections process. We did it at a very ad hoc manner. When we took on FeeSynergy Collect and the debtor management system, it definitely changed our collections and our debtor days. Mm-hmm. So that's why we're here. And as obviously you know, cash flow is the lifeline of businesses today. So to start off with, what is the first thing a small business needs to do to implement best practice debtor management processes?
Yeah, look, it's a good question. In fact, one that every business should be asking itself as soon as they open the doors for business, frankly, because cash is king. If you haven't got cash flow, you haven't got a business, frankly. Every business, no matter how small, needs to have a documented credit management policy. Absolutely. And it needs to be understood by all members of the team, staff, directors, partners, whatever it might be, and it needs to be applied consistently to the process, so to the clients. The best way to implement such a policy is to have it built into your business systems. So no matter what accounting package you're using, has it got the capacity to provide a reminder service or something to help you manage your debtors? If it does, absolutely jump on that. But the key thing, as I say, is to know what your credit policy is and to be consistent in application when talking to clients.
Just for the listeners that aren't familiar with what a documented credit policy is, what are the things that go in there?
It starts with what your trading terms are. So in the industries that we tend to work with, which in the professional services, most firms will have a 14-day trading term. So they send out the invoice and they want to get paid within 14 days. That's fine. It needs to be clearly spelt out on the invoice so the client knows. The first thing you do when you get an invoice from anyone is look at how much it is and then look at when it's due by. So that having that displayed very clearly on an invoice is a good starting point. So the clients know straight up what the expectation is. As far as other things, I think don't be afraid to talk to your clients about paying your bill. If you've done a good job and you've delivered the service or the product, they know they've got to pay for it. So don't be afraid to have the discussion. I think for all small business owners, it's out of their comfort zone asking clients to pay. So even the clients of yours, they've got clients. So they're going through the same, thought process. But don't be shy about it. That would be my one recommendation.
What I wanted to talk about next is obviously you've got a documented credit process. Is there a requirement to do sort of credit checks on your clients when you first take him on? Is that a standard process or one that you recommend?
Yeah. Look, it depends on what industry you're in, what product or services your company is offering, but certainly credit checks, they can take many forms. You're not required to do it, of course, but if you don't do some form of credit checking, and I'll come to what that might look like in a minute, then you're taking a risk, maybe an unnecessary risk. And depending on the size and nature of the transactions, how well you know the client, then that would dictate what sort of credit checking you do. So they're pretty basic sort of things that can be done. But check that they're actually paying their bills on time. But credit bureaus is the other thing that if you've got large transactions, and certainly in some industries where you do a lot of work for a client before you bill them and get paid, and I guess I'm looking at you, Savan, accountants and lawyers typically do that. The minute you start doing work for a business or client, you're actually providing them with credit, okay? So you've got to know, are they credit worthy to start with and how much you're prepared to do before you insist on payment and get payment. So if they're larger amounts, and it's up to you to determine what you would view as a large amount, using a credit bureau like Equifax, which we use in our finance business, just makes perfect sense because you can see straight away whether that client, whether they're credit worthy, we see their credit score, you can see how long it takes them to pay their suppliers, what their trading history is, whether they've been directors of failed companies, all the sort of stuff that you would expect to see in a bureau report. Very useful for giving you, the comfort to know how much credit you're prepared to provide to that client before you embark on the work. And of course, those reports cost a bit of money, but it's good insurance.
And what are the costs roughly?
They can vary. I mean, with the credit bureaus like Equifax, you typically will take up a subscription or you can buy reports one at a time on an ad hoc basis. And depending on how deep you want to go in the information, they could range from as little as, $10 or $15 up to $100. It just depends on how deep you want to go into the client's credit history. So you would match that maybe towards the value of the work you're doing.
Yeah.
Okay. But also if you're providing services to an industry that maybe is deemed to be a bit higher risk than some others. In the world we live in now, you've got access to a lot of information that's free.
Yeah.
One of them is called social media. So we're big on, our finance business, we'll do ASIC searches, make sure the company's registered, all that sort of stuff. Go onto Google, their website, go onto the client's website and get a feel for what their business is all about, who the people are. So if you don't know them, all these sort of things are just useful to give you, a bit more insight into your client. And if they've got a premises, trucking shop, workshop or whatever it might be, actually go and visit them. Does it look nice and clean and well ordered? Is it being maintained? All those sort of 1%ers, as we would call them, add up to a good picture of the client. Does that make sense?
Yeah, no, great advice. I get a lot of calls from clients when they, get a client for the first time and it's a large contract and it could be a listed company or even a large medium-sized company and those companies sort of try to dictate terms on how they want to pay because they seem to be bigger, and clients ring me and say, I really want to win this job, but I'm nervous around whether I'm going to get paid. So you've given some awesome tips around the Equifax and doing the credit checks, visiting, and really understanding the management team and so on to make sure that you don't get,
Well, I think you raised a good point there. Listed companies obviously have got all access to their annual reports and things like that, so you can actually see what their financial performance is. But when you look at these reports, read between the lines as well, and your accountant's very good at helping you read between the lines of financials. But just because they're big doesn't mean they're going to pay your bill.
Yeah.
So I think a lot of people do get carried away. So, it's a big company and therefore we're prepared to give them, whatever they want. But in the world of finance and things like that, there's a thing called concentration risk. So if you've got one big client and a few small ones, but if you've got one big client that makes up a fair chunk of your revenue, you need to be very careful about how you engage with that client, make sure that they're going to be able to pay for the services you provide.
So I wanted to talk a little bit about tax invoicing and the actual invoice that the customer receives from the supplier, obviously. What are best practice tax invoice strategies that you've seen or you believe customers should do?
Well, I think the basics that I mentioned before, having a payment due date, what I call a clean looking invoice. You see some invoices, we see lots of them, and they're just messy. And you think, well, how's the client going to read that? And, so have a really clean invoice that spells out very clearly the date of issue. Obviously, you've got to have your ABN and all that sort of stuff. There's compliance issues around tax invoices, as you know. But also, make it very clear when the payment's due by, how much it's for, and then a narration of some sort that actually is going to make sense to the client on the invoice. The work, what that invoice is for, so they can say, I remember that. That's easy. So I think it's just clarity of the invoice and nice clean layout would be one of the key things I would recommend. But as you would know in your own business, Savan, these days you can have URL or links to payment gateways to make credit card payments. You should display all the payment options to the client actually on the invoice in what was the old remittance advice area. If you are a business that takes credit card payments, you need to be aware of some regulations around what's called PCI DSS compliance, which is the global standard for handling client credit card information. There's very strict rules around that. So if your invoice has got the traditional boxes and dashes for collecting credit card information, fill it out and post it back to us or fax it back to us. You need to have a good look at that because that is not going to help you become a PCI compliant business. So they're probably the key things, Savan, that I would recommend companies look at.
Fantastic. And that kind of leads into perfectly to my next question around payment methods. There are many options. We have BPay, EFT. You touched on credit cards. Is there a particular method of payment that works, or do you just need to provide all options for clients?
Again, depends on the type of business you're in. But I guess credit management or getting cash collections 101 is give the client as many options as you can to enable them to pay. So if it's credit card, BPay, EFT, doesn't matter what it is, try and give them as many options as you can to enable them to pay your bill. Now, one of the things that we've seen significant growth in has been use of debit cards. And I think one of the things that people need to be aware of is there are rules around credit card payments about profiting from merchant fees that the banks charge. So credit cards attract a slightly higher merchant fee than a debit card. So if you are offering, well, you should be collecting both credit card and debit card, making it optional. If you are passing on a surcharge to the client, just be careful that you're not profiting from it. And it's a very easy thing to work out. You just look at the bank statements for your merchant statements and you'll see exactly how much your bank is charging you for credit card and debit card payments. And so that's just something to be wary of. It's something that's probably not well understood, but it's been in legislation for a long time. So,
And what's the biggest mistake that business owners make when it comes to debtor management?
The biggest mistake, probably being too soft on their clients, would be one of the major ones. But I think that most business owners don't like chasing clients for payment. They just send out the invoice and hope the client does the right thing and pays. But I think being soft on clients, cutting them too much, giving them extra time to pay, not having a consistent approach to the way you follow up debtors. A lot of businesses give the collection process to unskilled staff. So it might be a junior staff member who's got no skills around negotiating payments or whatever, and yet the owner of the business, delegates that responsibility, or abrogates, I suppose is more appropriate, to people who maybe haven't got the right skill level to negotiate payments with clients. So that's a big mistake that a lot of businesses make.
The next section I want to touch on is a little bit more into the credit card section and even talk a little bit about direct debits. Direct debits, credit card charges are being used more and more often. You mentioned obviously it is a good strategy for collections. Can you talk more about the PSI and the legislation around the credit cards so that we get a bit more of an understanding of that?
So I think, as I was saying earlier, there are rules around holding or collecting client credit card information. So if you are collecting, if you've got an FPOS terminal or something like that, where you're swiping the card, that's called a card present transaction. So there should be no issue around you having that client credit card information. You don't need it. But if you're taking payments from a client over the phone or through your website or something like that, you've got to make sure that whatever you're doing, the card details are not stored anywhere. Okay, that the best is in fact what your firm's got, where it's a bank to bank. So the client's putting their credit card information in an Alexander Spencer payment gateway on the website. That information is passing straight through to, in this case, Westpac Bank. So no one's touching it. You don't have access to the number, not being stored or saved anywhere. So just being careful around that is very important. And there are simple ways to overcome that in this day and age.
So obviously direct debits are a strategy that business owners can apply for either services rendered or, being able to charge a client for an amount that was owing previously. What are the rules around direct debits and how do you go about in administering that?
Look, direct debits for many businesses can be a fantastic addition to their, payment offerings to clients, but there are certainly rules around it. The direct debits are, administered by the banks through a network, the payments network, I think it's called, but there's a thing called the BECS compliance, which is bulk electronic clearing system, which controls or sets the standards for what you're required to do with direct debit forms. In the least, the forms that you issue to your client to be signed for a direct debit have to be in a prescribed format. There's certain things they must contain, and the client signing it should be the one who's authorised for that money to be drawn from the account. So there are many of these sort of facilities around, but there are certain things that are not negotiable. But the last thing you want is to be drawing money from a client's bank account or credit card and then one day get a chargeback. And I think that term is one that you'll hear. Chargebacks effectively is where the person who has had the money coming out of particularly their credit card, I should say, says, well, hang on, I don't think that's right. I've been charged incorrectly. And they can challenge that payment simply by going back to their own bank, who will then take it up with the bank that the merchant is with. And in Alexander Spencer's part, the merchant is Alexander Spencer. So, and I think the Westpac is your bank for that. So Westpac will come back and say, well, we've received a charge back from this client's bank. You got to now produce within 3 days the signed direct debit authority. And if you can't, or it's not in the prescribed form, or it wasn't signed by the right person, or wasn't in the right legal entity, you know what? You might have that money taken off you again. And these can go back many years. The rules actually protect particularly consumers for many years. I think 7 years they can go back and challenge. But look, they happen from time to time. In the FeeSynergy world, we've got thousands of businesses on direct debit of all types, and we get chargebacks, I don't know, on average probably 1 or 2 a month maybe. We've never lost one because all our direct debit authorities are in the prescribed format and they're all been signed properly, and there's no dispute over what the services were for. And in our case, it's obviously for accounting and legal fees. So we've never lost one in 14 years chargeback.
I've seen vendors do this in some industries, but what is your view on businesses providing customer discounts for payments made by a particular date or early?
Discounts, again, it comes back to what business you're in as to whether these discounts are worthwhile or not. And I think from my perspective, a discount, it might be 5%. If you pay by a certain date, you'll get 5% off, right? Now, if you're going to do that, that's fine, that's fine, but just be prepared for the clients who then still pay you late and take off the 5%. Because if you're prepared to take 5% discount then, that's human nature. They say, 5%, I'll just take it off the bill anyway, even though I'm paying 3 months later. So if you are offering discounts, you need to be really rigid about the way you apply them and make it clear to the client. Don't be paying me late because that 5% is only on the table for as stated on the tax invoice or whatever you're providing. So look, they're a tricky one. They work often in certain industries where people are used to that, but certainly in the industries we tend to work with, particularly in accounting and legal, I recommend our clients not to be offering discounts. Okay?
Yeah.
But it's up to the firm to decide whether it's in their something they're prepared to do. But yeah, but just as I say, just be prepared for the client to take the discount off anyway, even if they pay you late.
Yeah, no, that's a good tip. Conversely, to discourage late payment, fees for late payment, actually adding a fee. I haven't seen that too often these days, but is that a strategy that you have seen or you recommend?
Look, it's a strategy I've seen many times over the last 30 years, but I've never seen any really work effectively. My view of the world, and these are again my views, and it comes down to what business you're in. If you have on your invoice late payment will attract a interest component or a fee, or that's a threat to your client. That's the way I view it. You're really threatening the client to say, well, if you don't pay by this date, things are going to happen. I don't know that sends the right message to clients. Certainly in a professional environment, I don't think it does. But also, what you really want is if a client is struggling, not to be penalising, you actually want to be engaging with them and negotiating something that works for both of you. So, I have a view about it. I've never seen anyone actually then apply it, so why have it on there? If you're not going to do it, don't put it on your invoice.
Something that's worked for a lot of our clients is regular reminders and having a systematic approach that is backed by technology. FeeSynergy Collect that we use powers our regular reminders. So I want to talk a little bit about that. Can you broadly just give us what are the best practice regular reminders that you would encourage small business to apply in there?
Absolutely. I think clearly one of the main reasons businesses don't get paid as quickly as they would like is because they don't remind their clients to pay their bills. Crazy as it might sound, they send out the original invoice, it's 14 days, 21 days, 7 days, or whatever it is. So when a client gets the invoice, they say, oh, good, I've got 7 days to pay that, or 14. They just leave it sitting in their computer or print it out and put it in the in tray or whatever it is. But if you don't remind them to pay, then they don't, or they just forget. Most businesses don't like to pay ahead of time. So if they've got 14 days to pay, you know what, I'm going to take that 14 days. But then they forget about it, or they say, well, I'll just wait till Savan, rings me up and reminds me. But if you don't send reminders, then you will have slow paying clients. There's no doubt about it. So I think our best practice in the world we live in, dealing with accountants and lawyers and their clients, our small businesses, is to send out a reminder either 2 or 3 days before the invoice is due, or maybe on the day that the invoice is due. Friendly reminder to say, send that invoice, and hopefully that'll prompt the client to pay. If you don't get payment, then you need to send out another reminder. We recommend every week that you be sending out reminders up to a point. So in the system you're using, Savan, that you mentioned, obviously the FeeSynergy Collect data management platform, it's all automated. So if you're a small business and you've got access to an automated reminder system, absolutely do it. But it comes a time in that credit cycle where you might have sent 2 or 3 reminders to the client and the client still hasn't paid, that you need to get on the phone and, don't just keep sending out reminder after reminder, friendly emails or, SMS. I've viewed about SMS messages as well. They work in some industries, but they're not really ideal for professional services, for example. Someone eventually is going to need to get on the phone, talk to the client and find out why they're not paying. Now, short of them being unhappy with you or the goods that they've got are no good or whatever, you want to have that discussion with them sooner rather than later. You'd rather know that, quickly, rather than let it drag out for 30, 60, 90 days before you then find out, oh, okay, I didn't realise that. So whilst we heavily automate the process, sometimes nothing's better than a human on the end of the phone. And there's no getting around that. So, but we do know that through hundreds of firms that we work with, the reminders, reminder 1, 2, 3, automated, they get a result. 80% of the cash will come in, okay, but purely through the reminder process. And then the other 10, 15, 20% where they're a bit slow, you talk to them and find out why they're slow. They might need a payment arrangement. And they say, Savan, it's $2,000. Can I pay $1,000 next week and then $1,000, the following month? So yeah, that's fine. At least I know.
Yeah.
So those sort of conversations need to be had. But yeah, automated reminders are absolutely the way to go if you've got access to the technology.
So there'll be obviously some debtors that you might not get anywhere with.
Yeah.
So the next sort of topics I want to talk about is what do we do from a legal action? What grounds do we have in that space? So when should a business owner refer a debt to a debt collector or a lawyer? What are the next steps?
Yeah, look, it's a tricky one. And again, for a lot of businesses that they think, they'll pay, they live in hope. A lot of people live in hope that the client's going to magically come up with this money and pay them. But if you're not communicating with them throughout that 1 month, 2 month, 3 month period or whatever it might take, then you sort of don't know where you sit. But ultimately, if you decide, no, look, I've had enough, that client owes me $5,000, that's hurting me, there's no good reason for it, you got two decisions. You either look at, I guess the two main ways are looking at a debt collecting agency. A mercantile agency is the term that's an old term that they've got to have mercantile agent's license to do that. And the other one will be what I call going legal, going to a legal firm to help you recover that money. So the two are valid options, but it depends on, again, your business, the size of the transactions, how many debts are outstanding, all that sort of thing. So if you've got a lot of small value invoices that you're trying to chase, then I would recommend looking at probably a debt collection agency for those, because they're geared up with systems to do bulk chasing of money. They will typically charge a success fee for that. It's up to you to negotiate something with that agency, but potentially anything up to 25% of whatever they recover that they will keep, which is fine if they get a good success. If you've got larger amounts outstanding and you're at a point where the relationship's finished with the client, I don't want them as a client anymore, they're just not good for my business, I want to go hard and get my money, my recommendation is always to go legal on those large ones. Find a friendly lawyer. Some specialise in debt recovery, so they've got good systems for doing that. Mostly they'll just charge flat fees for doing things. Like the first part of that might be, say, a letter of demand to the client, and those letters of demand can range from as little as $75 up to a few $100s, but it comes down to how much the debt is. But if you go legal, there's a few things you need to be aware of, and that is, have you followed a proper process about trying to get the money from the client? So if you decide you want to go legal, and it applies to a debt collection as well, but the lawyer will say, well, have you provided the goods and services? Have the client accepted them? And say, yes, I have. And say, okay, have you evidence of invoicing them properly? And this is a trap for a lot of businesses, that when you issue a tax invoice to a client, make sure you've got the right legal entity on the tax invoice. Because if you ever need to rely on it in a court of law or whatever, the first thing to look at is, hang on, that's the wrong entity, so that's going to be problematic straight off the bat. So That's a tip for any business out there. Have you got evidence that you've tried to chase the client for money? And if you've got systems and things like that, this is the dates we contacted them, all that sort of stuff. That's important. You need to show that you've actually been through a process without it getting a result. And you also need to show that you've tried to negotiate payment terms with them. Okay? If they said, oh, look, can I pay over 4 installments, 1,000, yeah, if you say no, I just want my $4,000, that could be a problem as well, because really you're trying to negotiate an outcome which works for both parties. And if you are really recalcitrant on that, it's not going to be helpful in a collection process. Often when chasing debts, you're actually looking to get a payment arrangement in place with the client anyway. So you may as well do it as a small business, as the owner of the business. So I think the things that you need to weigh up is how much is the debt, what's the commercial viability of running it, is the company deregistered, and you probably, as an accountant, Sivan, you would know you can't deregister a company in theory with ASIC if you've got outstanding debts. But I'm sure it happens.
Yeah,
But that creates a problem then for the directors of that company if they deregister it.
Yeah.
So, but I think talking to, most accountants would be a good starting point for telling you, well, that's worth chasing or not. But you've got really those two options. The third option is one I won't talk about on air.
Fair enough. Malcolm, we talked about tax invoices and the compliance requirements around tax invoices. What do business owners need to put on a tax invoice or an invoice for their services to be compliant?
Sure. Well, there's some minimum requirements. The issuer of the invoice needs to have their ABN, the name of the business, ideally their address and contact details, and the word tax invoice if they're charging GST. So, and of course, when you show the amount that is owed to the client, you need to break it up between the amount plus GST and then a total. So they're really the only requirements of a tax invoice. But additional to that, from a best practice perspective, we would recommend you have clearly a narration around the services and the goods being provided, so the client is in no two minds as to what they are, but also very clearly show when the payment is expected by. And so a payment due date is the best way. I wouldn't say our trading terms are 21 days, so please pay. When's that? That's confusing for a client. Having a due date for payment is another really good tip, and it's helpful for the client. So I think they're sort of the tips, but clearly the thing that I see most, and I see a lot of invoices because we deal with thousands of businesses, some are just confusing. You look at it and think, well, how's my customer going to actually understand my invoice? So having a nice clean invoice, easy to read, there's going to be no confusion for the client. That would be my biggest tip around invoices.
Well, there you go. Well, I wanted to thank you for your time today. That was very informative. I think we got a lot of takeaways from debtor management, collections, and best practices. So thank you for joining us today, Malcolm.
Absolute pleasure, Sivan.
This is The Bottom Line, a show designed to help Australian businesses succeed. This podcast was produced by accountancy firm Alexander Spencer. At Alexander Spencer, we've been helping business owners realise their goals since 1952. And we play a pivotal role in developing, implementing, and supervising the business goals and strategies of our clients. To find out how we can help your business succeed, head to our website, alexanderspencer.com.au. To make sure you don't miss an episode of The Bottom Line, be sure to subscribe to or follow the show in your podcast app. And while you're there, leave us a 5-star review. It really helps others find the show. I'm Sivan Tuna, and we'll be back next episode with more tips to help you transform your business. And that's The Bottom Line.